Hello and welcome to this episode of Mic'd Up with ICM. I'm Pete Seiler, a member of the business development team here at ICM. And today I'm excited to be joined by Ken Shinoda from DoubleLine Capital. Ken, thanks for joining us.
Thanks for having me.
Awesome. So to kick off, I just want to give a brief background and a little bit of biographical information. You joined DoubleLine at its inception in 2009. You're the chairman of the Structured Products Committee and oversee the non-agency residential mortgage-backed securities team. You also are co-portfolio manager on the total return, opportunistic income, opportunistic mortgage-backed securities, and strategic mortgage-backed securities strategies. You also serve as a lead portfolio manager overseeing mortgage opportunity private funds. And you're a permanent member of the Fixed Income Asset Allocation Committee and participate with DoubleLine's Global Asset Allocation Committee as well. Ken, impressive. So excited to have you with me today.
Great. Excited to be here.
So let's jump in with just a kind of a high-level overview on the current state of fixed income markets in general, and where are you finding the greatest opportunities, and what do you see as also risks for fixed income investors today?
Well, it's been quite a couple years for fixed income, a massive repricing coming out of the world of low interest rate environment, coming out of QE, with a big rise in interest rates where we now have the treasury yield curve at levels we haven't seen in over 10 years. So broadly speaking, fixed income is the most exciting it's been in the last decade. Spreads had gotten very wide, especially into the kind of risk off of October. They've had a ferocious rally very recently, especially parts of the corporate bond market. Investment grade corporate bond spreads are like 10th percentile, meaning they've only been more expensive 10% of the time, and high yields just about the same. So the spreads have come in on credit assets, but one of the parts of the markets that have lagged have been agency mortgage-backed securities. These are government guaranteed bonds that are packaged pools of Fannie, Freddie, and Ginnie Mae originated agency loans. And also the non-agency CMBS market, which is commercial mortgage-backed securities, because of all the headlines around office space and stress in the commercial real estate market and regional banks. So the two places that we think have a lot of opportunity are those government guaranteed agencies and those commercial mortgage-backed securities.
Great. So let's dive a little bit deeper into the mortgage-backed security side. Can you give us a little insight into what's driving that market dynamic today?
Well, we went from a market of manipulation for many, many years during quantitative easing, where we created this unnatural buyer. The Fed came into the marketplace and they were gobbling up all these government guaranteed agency mortgage bonds, which drove the spread very tight, drove the volatility very low, and they were a very dominant player. The other buyer during peak QE were the banks. We sent out stimulus checks during the pandemic. The banks got money at the worst possible time when rates were basically zero, and they had to do something with it. And they piled in and bought treasuries and agency mortgages. So now that we come out of that market manipulation with quantitative tightening, we've seen a mass repricing of both rates going higher, spreads widening on these assets, but also the two biggest buyers, the Fed and the banks, taking a step back. And so that's helped to push spreads to levels that we haven't seen in over a decade. Agency mortgages on that same ranking that I gave you for corporate bonds, which were kind of like 10th percentile, agency mortgages got to 99th percentile last year. They've had a decent rally. Maybe they're about 85th percentile to 88th percentile today, meaning it's only been cheaper about 15% of the trading days over the last 10 years. But on a relative basis to corporates, it just hasn't been this cheap relative to corporates in also 10 years. So it's not only cheap to its own trade history, it's cheap on a relative basis to corporates. And CMBS is kind of in the same boat. They've kind of been trading neck and neck from that cheapest standpoint, relative to their own trade history and relative to corporates as well.
Awesome. And as a relative value manager, we love to hear that. So, if we think about the characteristics of the MBS sector, historically, you'd expect them to underperform in periods of declining interest rates because of the negative convexity associated with them. Given your current market expectations, lower rates are probably likely in our future. Can you talk about convexity a little bit and why the environment that we see today might be a little different?
Sure. Well, there's two risks when you own a mortgage bond. It's basically uncertainty of what my duration or what my average life is. Corporates and treasuries, they have a stated maturity date. You get your semi-annual coupons and you get all your money back on the maturity date. Mortgages, you basically don't know when you're going to get your money back. Prepayments could come in fast, they could come in slow. There's this variability of prepayments because borrowers at all points in time have the ability to prepay or not prepay. And so we have a metric we call weighted average life, which is it's our kind of way of thinking about when you get your cash flows back. And when you own a mortgage bond, you have two risks. One is that rates go higher and less people prepay, so your bond extends. And you will go from being a duration, let's say 5 years to 7 years, and you roll up the curve in a normal steep yield curve. That risk is almost non-existent because rates are so high that most of the universe is already massively out of the money. And so the market is already expecting very slow prepayments. So that's one risk that's very, very low, is that extension risk. The other risk, which is the one you mentioned, which is maybe a little bit more easier for people to understand, is that rates fall and everyone prepays. And so you thought you had a 5 year, you end up with a 1 year, you don't go up in price that much. You have callability, right? And that's that negative convexity that people think about in the fixed income space. That risk is also really low because everybody's mortgage rate is so low today. Most of the mortgage universe didn't buy a house yesterday. They bought a house 2-3 years ago when rates were really low. So the predominance of the mortgage market is in a mortgage that has a coupon of around 3.5%, 4%. That's the lion's share of the agency mortgage market. And mortgage rates, they got us almost to 8%. They're down a little bit. I bet you could get a mortgage with a kind of like a 6.5 handle today, maybe, if you move some money around in the banks. But think about that. That's 6.5% mortgage. Rates could fall 100 basis points. All those people with those 3.5, 4% mortgages, they can't refi. So the prepayment risk is just so low right now, both for extension and contraction, and everything is at a discount was made many years ago. And so if you own bonds that are at 80, 85, 90 cents on the dollar, let everyone prepay, please. Everyone prepay. I own these bonds at a discount, and it's just a very unique setup. The dollar price of the MBS index for many decades kind of sat between 95 and 105 because interest rates would move up and down, but not by that much. Call it 100 basis points trading range. And so mortgages would get made and traded, premiums and discounts. We were in such a unique environment where so many loans were made at such a low coupon, and then rates rose hundreds and hundreds of basis points. So the dollar price of the MBS index got all the way down to 80, which is the lowest it's been in a very, very, very long time. And so
Absolutely.
that's what makes it really interesting. The spread is cheap to its own history relative to corporates, and then the risk as measured by prepayment risk or convexity is basically the best it's been in 20 plus years.
Awesome. So as we kind of bring our conversation to a close today, mortgage-backed securities are really unique, but they're also a major segment of the U.S. bond market. A lot of investors, though, will tend to access the asset through either diversified core bond fund, a simple passive ETF. What are some key benefits of using an active and dedicated strategy?
Well, there's a couple tools that we have in the toolkit. The first is that the index is like a pro rata slice of the universe, and a lot of that's dominated by these low coupon mortgage bonds that the Fed happens to own a good amount of. They own about 40% of the float of these low coupon, 3.5% mortgages, and then the banks also own a lot of those low coupon mortgages. And so there are time periods where certain parts of the MBS market trade expensive because of the supply demand dynamic. Index buyers want to buy them, the banks and the Fed owns them, so you got to pay up to buy them. And so there's ways you can go underweight expensive parts of the market, go overweight cheaper parts of the market, and through what we call owning different parts of the coupon stack. And the coupon stack are different coupon bonds backed by different coupon mortgages, and they have different prepayment characteristics, and they behave differently based on the direction of rates. And so that's step one, is selecting the coupons to own. Then you can go to collateral. We use loan level data, and we dig into the collateral to think about, which ones will prepay faster or slower. And then depending on the price of the bond, the structure of the bond, we can find different collateral that we think is trading cheap or rich, right? And so that's coupon selection, collateral selection. And then there's two parts of the market that do not exist in the index. One of them is what are called CMOs, collateralized mortgage obligations. And this is when Wall Street buys pass-throughs and they slice them up into different pieces, typically slicing them up for the priority of payment. So a simplistic way you could tranche these securities is that the principal goes to a front sequential bond first, and the prepayments go to that front sequential bond first, making it a shorter duration. Then you create an intermediate sequential, which receives the cash flows next once that front bond is totally paid off. And then there's the last cash flow, which receives the principal and prepayments last. And so you've created 3 duration profiles for different buyers that have different demands and needs. And banks often buy that front sequential bond. The yield curve is steep, so they're paying up, or they're buying it at a lower yield because of the shortness. And there's arb in that for the banks, right? They can buy the pass-through at 102, they can slice and dice it and sell the pieces for, let's say, 102 and 8. Doesn't sound like a lot, 8 ticks, but do that billions and billions of times over with leverage, right? And that's how the banks make money. And there's times when those assets trade cheap because of supply-demand dynamics. But there are no CMOs in the index. That's another way to make some alpha, is to play opportunities in that CMO market. And then lastly, there are non-agency mortgages, which is what me and my team specialize in. I've been doing this since pre-GFC, maybe too long. But these are credit bonds. You don't get the government guarantee of Fannie, Freddie, and Ginnie Mae. So you need to analyze the underlying credits. We focus just on investment grade parts of the market and non-agencies, where you get to pick up some yield to agencies. And that yield pickup, depending on where you're playing, can be anywhere from 100 basis points for, let's say, the AAAs, and you can go down the capital structure and go up and down that coupon stack. We can play in the CMO market. We can play different collateral stories, and then we can add credit risk to our portfolios depending upon our views.
Jen, truly great information. I want to thank you for joining me today and sharing this with our viewers. Thank you for joining me.
Peter, thanks for having me. Good luck out there, everyone.
Absolutely. Thank you for watching this episode of Mic'd Up with ICM. If you have questions, comments, or want to suggest a topic for a future episode, please do reach out to us at 888-426-4689 or via email at info@icminvest.com. Thank you.